How's it going, friends and family? My name is Amos, and everyone says to just use a high-yield savings account when it comes to parking your cash. But what if your cash needs to sit inside of your brokerage instead of a bank account or a dedicated money market fund, right? So today, I'm going to be breaking down the safest places to park cash so it earns something without stressing you out. That way you can sleep soundly at night while you snore a little too loud and your wife is annoyed at you in the morning. We're going to be taking a look at Treasury ETFs, which are basically the closest thing to cash while still earning a dividend income. If that sounds good with you, let's go ahead and get into it. So what exactly is a Treasury investment, or in this case specifically a Treasury bill? Shortened form is T-bill. A T-bill is a short-term loan that you give to the United States government that matures in a very short duration, usually less than 12 months. And when it comes to T-bills, it's considered one of the safest investments in the world because it's backed by the full faith and credit of the United States Treasury. And because T-bills are investments into the United States government, there's tax benefits. You do not have to pay state and local taxes from the distributions. I think you're still on the hook for the federal taxes. But do keep in mind there's three variations of Treasury investments. Number one is a T-bill, anything that's less than 12 months or less until it matures. Number two are the Treasury notes. Usually matures within 2 to 10 years, so a little bit longer. That means you're giving your money to the United States government for up to 10 years. And after 10 years, you get your money back if you go directly to the government. But if you invest into a Treasury ETF, they do all of that for you, and instead you get the distributions on a quarterly or monthly basis. And then number three, there's Treasury bonds. And for bonds, it takes 20 to 30 years to mature. I really don't understand why people put their money into Treasury bonds, but that's an option. So that's why we're focusing on T-bills. And there's three key considerations before choosing a T-bill ETF. Number one, we'd have to get this out of the way. A T-bill is not a REIT. It's not a semiconductor AI movement stock, and it's not the Mag 7. T-bill ETFs are designed for capital preservation. So when you try to evaluate them using the normal metrics of like total return or CAGR, that's not the right lens, okay? The goal is safety and yield. And while we're on the topic of safety, that's the second consideration, right? They're all backed by the US government. So safety is virtually identical across the board with the four recommendations that we're going to be talking about here today. And then consideration number three, interest rate sensitivity. This is where the small differences will show up, and I'll explain that as we go through each ETF, from T-bills to T-notes. I'm obviously not going to be covering T-bonds, because it doesn't make sense to me, all right? Well, I guess instead of being so judgmental, I guess there's people out here where their risk tolerance on a scale of 1 to 10 is a 0. So they would rather have their cash tied up for 30 years and then to get like a, 4 or 5% return on investment. I guess for some people, that's better than nothing. So I'll stop judging. But I do want to throw this out there. Even though your cash will be tied up into that bond, every 6 months or so, the United States government will throw some interest payments to you. So if we're talking about a 30-year Treasury bond, you should get 60 interest payments. And you can always change your mind and sell your bond on the open market as well. Just because you put it in for 30 years doesn't mean you have to wait 30 years. It's just like buying a house with a 25-year mortgage. You don't have to wait 25 years to sell that house, okay? If in 5 years in, you don't like your neighborhood, you don't like the school district, you can pack up your bags, put it on the market, and sell it. But I digress. Let's go ahead and talk about the T-bill ETF number one, and that's going to be SGOV. The iShares 0 to 3 month Treasury bond ETF. I know the name of it has the word bond in it, but rest assured it's all into T-bills. So it's an ETF that invests in treasuries that mature in 3 months or less. And on the risk scale, along with all the other ETFs, it's a 1 out of 10. It's super boring. It's very safe. Literally, virtually, no risk. I mean, there's a little bit of risk in case there's like a sudden catastrophic event and you can't pull your cash out. But if that happens, I mean, we're all screwed anyways, right? So what happens if there's rate cuts when it comes to SGOV? So because SGOV is holding a whole bunch of different T-bills that mature next month or in 2 months, its yield quickly resets to whatever the new interest rate is. But on the flip side of that, it doesn't matter what the interest rate is. The name of the game for SGOV is capital preservation. So you're not really going to see any volatility, despite a stock market crash or black swan events. Case in point, if you take a look at SGOV year to date, it has a pretty predictable pattern. The lows are $100. It goes to their highs of $100.68, and it repeats that cycle again and again and again in a very predictable manner. If we zoom out 1 year, nothing really changes. And if we do 5 years, it's almost the exact same situation. I know visually it looks like there's a huge drop off, but we're talking about the difference of like $100.58 to its low of about $100.03. That's like 50 cents, right? You've maxed it out, publicly listed May 2020 during the pandemic, $100.01, and now it's $100.43. It did its job. Its advertisement is that we're going to preserve your cash and pay you a dividend distribution depending on the federal interest rate. So all-time total return in terms of the share price appreciation is 0.42% into the green. But if you bake in the distributions, the dividends that were paid out, you should be in the green. I don't know, the CAGR is probably like a 3.5, 3.8%. And do you remember how earlier this year in April, there was a market-wide sell-off and everybody went into the red? Well, look what happened to SGOV. They just continued doing their very predictable stock price pattern. So how it behaves in market corrections, it's just business as usual. Because even though people liquidate and sell out of stocks and it causes them to go into the red, with Treasury bills, notes, and bonds, it's the exact opposite. Whenever there's a lot of uncertainty or market corrections, that's when big money, hedge fund, and Wall Street investors, that's when they pump their money into these safer investment vehicles. And that's why it maintains that very stable principal valuation. And just to verify what their CAGR is, you don't invest into Treasury bills or notes or bonds for the performance, but I'm just curious, what's the CAGR? So if you take into account their total stock market history of about 5 years, then your money would have grown by 3% year over year. Just the past 3 years, we're at a very historically high inflationary environment where the interest rates are bonkers, right? That's why your high yield savings account with whoever you choose to bank with, that's why it's around like a 3.2 or even like a 4%. So the CAGR would have been 4.8%. It follows the federal interest rates. So that's ETF number one, very safe place to park your cash. And then number two, they're almost identical, but it's by another firm. And that's going to be the Spider Bloomberg 1 to 3 month T-bill ETF, otherwise known as ticker symbol BIL. This is the exact same thing pound for pound as SGOV, the exact same concept and same strategy. And for those of you that think these ETFs are stupid and it's a waste of time, I'll tell you this right now, okay? It's never the wrong idea to have some gunpowder in the reserve. That way, if a flash sale happens before your eyes, let's say that you've been eyeballing a company for like 2 years, 5 years, and they're finally at the appropriate buying price and you have no cash available, what are you gonna do? Are you gonna go on margin? Are you gonna take out a loan? But if you've got some highly liquid investment options like, I don't know, a T-bill or some money in your money market fund, then you can pull the trigger and dollar cost average into whatever you're eyeballing, right? And before you talk about how these opportunities don't happen that often, dude, in 2025, you saw how volatile the stock market is because of that big T word, tariffs, and the geopolitical tensions happening around the world. But also, do you remember in April when the entire stock market went on a sell-off? To have some gunpowder then would have been clutch. Agree? So before you dismiss it and say this is stupid, I don't think it's that stupid. Having some cash on the sidelines is my rule of nipple. You don't always want to be 100% into equities. So as we take a look at BIL, are we going to see the exact same thing as what we saw with SGOV? Let's put them to the test. If we zoom out 5 years, you might see that visually it's a lot of peaks and valleys, right? But let's put it into context. At its highs, we're talking about like $91 and roughly like 82 cents. And at its lows, I mean, let's take a look at the lows, right? $91.33. That's why visually it's a little deceptive. It looks like it's swinging pretty big, but in the past 5 years, the total return in terms of their share price appreciation is negative 0.03%. So relatively flat. You would have maintained your capital. So it would have preserved your principal amount. But you would have gotten a dividend distribution every single month. And if we zoom out to take a look at their total stock market history, they debuted in the stock market in 2007, right before the great financial recession, 2008 to 2009. It was $91.62 in 2007, right? During that Black Swan event, their very lows were still about $91.64. So as you can see, not too bad, but this part, is it a little alarming? You see that valley in 2015? $91.38. So whatever you put in, you practically would pull out the same amount. But if we really want to be nitpicky, let's assume that you bought into the absolute highs, 2008 at $92 a share of BIL, and at its very low, you would have lost 0.7%. But I feel like the dividend distributions that happens in that time frame, you would still come out in the green. Speaking of which, let's go ahead and take a look at SGOV's holdings. So Treasury bills are what? It's money that you loan out to the United States government, and it's investments that mature within 12 months. So if you take a look at the holdings within SGOV, it's going to be all Treasury bills. And you can see the different and various maturation dates, like this one matures December 23rd, December 16th. They'll have every single one of the T-bills out there for the next 90 days. So very straightforward and to the point. Jump on over to their dividend profile. The dividend growth, you got to disregard. It really depends on what the federal interest rate is, okay? The distribution schedule is every single month, so every 30 days, it's practically a high yield savings account, except you get tax benefits. Dividend yield is 4.15%, reflective of the current federal interest rates, which at the time of making this video, it's 3.89%. And the reason why it's a little bit higher is because they bought into the T-bills about 40, 50, 60, 70 days ago that locked in the previous federal funds rate. So pretty straightforward. Every single month you can expect a dividend, and the dividend growth really depends on what the Federal Reserve Bank decides to do. If we jump on over to their cousin, looks exactly like them, okay? 4.14% dividend yield. I mean, it really doesn't make a difference. The payout distribution is also every single month. Jump on over to the holdings tab, and it's pretty much the same as SGOV. But I do want to call this out and mention there is a pretty stark difference. So this one, the expense fee is 0.14%. So that's how much they take away from you as the fund manager fees. Because this ETF can't just exist for free, right? Even everybody's favorite SCHD has an expense fee. It's 0.06%. Everybody has to eat somehow. So if you take a look at SGOV, their fee is 0.09%. So that's why I'm thinking the dividend yield for SGOV is slightly higher because they're taking less fees away from you. It's baked into the performance already. That's why the dividend yield for BIL is 4.14% while having almost identical holdings of T-bills in their portfolio. Just what I am thinking. And the next Treasury investment option is a little different from SGOV and BIL, and it's the iShares Treasury Floating Rate Bond ETF. And I know it says bonds, but it actually invests into notes that mature when? 2 to 10 years. So even though TFLO is invested into notes and not T-bills, it's almost exactly the same level of risk, 1 out of 10. It behaves the exact same in market corrections, pullbacks, rate cuts. Case in point, if I show you the total history, it debuted in the stock market February of 2014 at $50.10. And since then, it's literally maintained its capital just throughout the time, throughout the ages, no matter what weird event happened in the stock market. When everything else went into the red by 25% into the red, TFLO maintained its capital around $50 and some cents. The only time where there was a weird thing that happened is right here. December 2014, it dropped to $47.83, but then the next day it recovered like nothing happened. I don't know what happened there, but it is worth noting and observing. So even as the pandemic sell-off happened, they maintained their NAV of about $50 and some cents. And then earlier this year, during that April sell-off, what happened? They maintained their predictable and reliable stock price pattern. So I think what I have learned is when it comes to buying these Treasury investments, I mean, we're talking about pennies here, but don't buy them at the top of the peaks at like $50.64 or $50.66. Instead, it's almost predictable. If I were to buy them, I would buy it at a price point that's near the valleys of like $50.47 or I don't know, $50.48. And it looks like right now they just hit their valley of $50.44. So they're gonna go back up to like $50 and 60 something cents and then drop back down. I would wait until it drops back down next time. That's personally what I would do. I'm not telling anyone else what to do with your money, okay? So if there's rate cuts, it preserves your capital. Just like SGOV, just like BIL, TFLO is no different. But if the rates go up, then the income that they pay you will also go up. If the rates go down, the income will fall down as well. And just for fun, if we jump on over to the holdings tab, it seems like most of their notes are maturing in 2027, 2026. Yeah, so about 1 to 2 years out. It seems like TFLO, they're not really buying into anything that matures 5 years out or 6 years out. And the dividend profile of 4.23% dividend yield. Distribution is every single month. The reason why it's higher yield and Treasury investment option number 4 is the FM US Treasury 3-month BIL ETF. Now this one, it might sound exactly the same as SGOV and as BIL, but it's not because they only hold 3-month T-bills. So it's kind of like buying and owning a T-bill directly because you're not going to have 1 month, 2 month. They're all going to mature in 3 months from now. And I'm going to tell you right now, this is an exaggeration, but T-bill will have slightly higher interest rate sensitivity than SGOV or BIL because when the rates or if the rates get cut, SGOV, they adjust immediately, right? But with T-bill, it's going to take a little longer for their dividend yield to adjust because it's locked into the current 3-month bill until it matures. So the bottom line up front is SGOV reacts faster to interest rate cuts. So if it gets cut, that yield is going to come down fast. With T-bill, it's going to react slower, but what's more important is capital preservation, right? Click on the max. They debuted in the stock market in 2022 at $49.78, and since then, it's been operating in a pretty predictable manner and fashion. If I were to make an educated guess, it looks like they just hit their little valley, and they're rebounding back to their tiny little peaks, which it looks like once they hit $50, they go right back on down to like 49, 80 something, and they repeat that cycle again and again. Jump on over to their page. We can see that their expense fee is 0.15%. Take a look at their holdings. And it looks like they have 99.6% of their money in this ETF into the T-bills that expire February 26 in 2026. So it looks like their strategy, instead of buying a new T-bill every single day to adjust for the 90 days out, they roll their entire portfolio into the next 3-month T-bill once a month, usually on the last business day of the month. So kind of an interesting strategy to say the least. But in all case and purposes, nothing so drastic that they're very different from their competition of SGOV, TFLO, and all of them. Dividend profile, 4.12% dividend yield paid out every single month. So just for fun, I kind of want to compare them from their total return stance. I know it doesn't matter, but just for my own sake, I want to compare the two that literally look alike, which is SGOV and BIL. So with $10,000 invested into SGOV or BIL on June the 1st of 2020 to today, you would almost have the exact same thing. I mean, if we're going to be splitting hairs here, I guess BIL comes out on top. Looks like the average total return per year is 2.7% to that of SGOV's 2.6%. But honestly, it's not that big of a difference, right? That's with the dividends reinvested, and without reinvesting it, it's almost the same thing once again. I guess if we round up, then SGOV is 2.5% every year, and BIL was 2.6%, but still, 10 grand turned into 11,400 something dollars. It's pretty much the same. And if we do the exact same thing with SGOV versus TFLO, pretty much saying the exact same thing. So it looks like if you park your cash into a Treasury investment option, you should still walk away with how much you put into it, minus probably a few pennies if you're unlucky. But as you saw by their stock price pattern, I guess I would personally choose to withdraw when they're near their peak, but it really depends. If you withdraw during their valleys, you might walk away in the red by like what, 0.01%, negligible. So having seen all of the data and the numbers, I just want to give some additional commentary, okay? So when it comes to these Treasury investment ETFs, remember, all four are backed by the US Treasury. It's super safe. On the risk scale, 1 out of 10, if that. Dare I even say like a 0 out of 10. And when the interest rates get cut, or if there's a market correction, their stock price is still stable, but the distributions that you get will be reduced. So the yield will drop, but the stock price should be stable, plus or minus like 10 cents. Not really that big of a difference to move the needle. So I think it fits the definition of capital preservation. And because you're giving loans to the government, you pay less taxes. So I think after making this video, I think now I see the light, and I understand why some people go with T-bills instead of putting their money into a money market fund or high yield savings account, because you pay less taxes. And I think it makes a huge difference if you live in a high income tax state like New York, Hawaii, or California. And because they're all basically the same thing, how I would do it is I would probably go with the lowest expense fees, because the strategies here pretty much identical besides the holdings. So for me, I think SGOV would be number one. It has the biggest assets under management, $64 billion of investors' monies invested into this ETF, plus the expense fee is 0.09%. In comparison, their cousin, $43 billion, which is a lot, but the expense fee is slightly higher. I don't think the rates are going to go up anytime soon. If anything, I think the rates are going to get smaller and get decreased. I don't know if it's going to happen this year, but most likely next year. And because it reacts slower to the cuts, I like the fact that it's going to give me the higher yield for just that little bit longer. It makes a small little difference to me. I know, it really doesn't matter, but if I had to, I think any one of these four, not bad. I guess that's the point that I'm trying to get across. Personally, SGOV makes all the sense in the world, but BIL is good too. TFLO, they're all good, okay? My question is, what do you think? Do you like Treasury bills, Treasury notes, Treasury bonds, or are you 100% invested into equities? There's a YouTuber that I watch, PPC Ian, and in his like 20s and 30s, he used to be 100% into equities. All of his money were invested into dividend stocks. He didn't put any of his money into bonds. He didn't even have an emergency amount of money parked in the reserves. Every single time he got a paycheck from his job, he would just put it directly into his stock portfolio. And as I got into the stock market in 2019, I kind of took his experience to heart, and that's what I've been doing as well. Except my risk tolerance is a lot lower than PPC Ian's, so I do have some cash parked in the sidelines. That's what I do. But I want to hear from you guys. What do you do? Anyways, hopefully you enjoyed the video, and if you have a stock analysis request, don't forget, the link is in the video description and in the pinned comment. If you really want to hear my take on a stock, give it a go, okay? Anyways, I love you guys. Stay safe. Good luck in the stock market, and I will talk to you next time.